of all the fintech opportunities that were out there, I thought this really had some legs. Well, they, like everybody else, have also endured the season of ridiculous valuations, which started halfway through 2021 as the United States basically printed, we say printed, but it's not really printed more, it's like put into circulation, 1.4 trillion with a T, trillion, so it's no longer B's, it's T's, $1 trillion, and we gave everybody the COVID relief checks, et cetera. Well, that drove asset prices up when one of the assets is the implied valuation of a startup. And so away Stripe went, they really popped up, and in 2021, their valuation was $95 billion valuation. Kellyanne, somebody believed they were worth $95 billion when they put money into them. And by the way, people say, well, is this one of those billion-dollar rounds? No. They've had multiple rounds, and the one that I'm talking about today that they just completed is Series I. I believe it's called Series I. And so previously, they'd only raised about $2.2 billion over Series A, B, C, D, E, F, G, H, showing all those rounds. That's all they had raised. And they went out and raised money in 2021 at a $95 billion valuation. Well, they went out recently, and there's a lesson here for all of us, is that there is a good time and there's a bad time to be going out trying to raise capital. And the good times was 2021, and right now we're coming in a tight time. So let's go take a look at Stripe, what happened. So they go out at the end of last year, early this year, people starting to get back to work, some things are shifting back, COVID, not back to normal, still a lot going on, but nonetheless, it wasn't what it was a year prior. So the end of 22, some normalcy coming back. And they went out and they wanted to raise a bunch of money at a $55 billion valuation. Well, actually it was more than that, but it was significantly down from the $95 billion valuation they had raised toward the, second half of 2021. And they're going out this time, they were looking for $5-6 billion. So this is a company that's raised about $2.5 billion, and another 6 is gonna bring them up to like $8-9 billion. So this is a big raise. And they're doing it with, a little over $55 billion in valuation. They get to February and they're having trouble doing it. There's rumors that they were trying to go public, and they're like, no, we're just trying to raise a round. And now the rumor is that they've got a hard cap on $55 billion valuation. And then it came that they haircut that down to $50 billion valuation. They just raised money, just now. $6.5 billion was raised at a $43.5 billion valuation. So $43.5 billion valuation. Down from 95 in 21, down from way over 55 at the beginning of the year, down from 55 in February, down from 50, we settle on 43.5 billion, we raised 6.5 million, 43.5 and 6.5, pre-money valuation plus the money you raise is post-money valuation, 50 million on the nose. And this is a great company. You got to remember what Stripe has achieved and what they're powering. This is not some fintech that says maybe we're going to do something, maybe we're going to get to something, maybe something's going to be there, and this is what we hope. This is an established company that's out there raising money, for Series I. They've raised money successfully. But anyway, they've now raised 8.7 billion with 6.5 billion raised just now. And so that shows, so here's a lesson for us. Number one, I think it's very helpful to see how great companies go. So go watch the original Biz Doc case study on Stripe, and then go back in and just search any one of a number of articles you can find recently. Go Stripe financing, 6.5 billion. And you'll find a bunch of great articles on it. Crunchbase is out there, TechCrunch is out there, or even Business Insider. Those are usually locations for news that get it right when it comes to, earlier stage companies that are out there raising capital. But now we'll give you the story. So what's the lesson for you and me? The lesson for you and me is if you're trying to raise money right now, and a lot of you reach out and say, hey, Biz Doc, can I talk to you guys about raising money? Sure, talk to one of the valuetainment guys. Let's put together an engagement. Let's look at a pitch deck. Let's look at your elevator speech. Let's look at your business and your differentiators, all of which I'll do an engagement with you, and let's see if you can go out and raise money. And sometimes I tell you, even if you put this in the best way forward, it's going to be really tough to raise money right now. You have to maybe find friends and family and close-in capital. Otherwise, it's going to be tough. But right now, you take a look at Stripe going from 95 on the value down to 43.5. That's, less than half of the peak valuation there. And so right now, you got to focus on being lean, number one. Number two, you got to focus on knowing your expenses. And we talked about this last week, by the way, when we were talking about knowing where your expenses are and knowing what are you paying right now. We were talking about how cable TV expenses in life and business can creep up on you and knowing where you are. So living lean and focus on growth. Most investors want first a growing organization to invest in, point one. Point one is the entrepreneur has to be bankable. So that's a table stake. Do I believe this entrepreneur can do what they're saying in the market they're talking about and be successful doing it? Do I believe that? Second point, okay, what have they built here? And do they have skin in the game? Yes. Third point, show me the growth. Capable entrepreneur, great company that they have skin in the game and they have built this, and then are they growing? Are they getting traction? Are they making the second, third, and fourth sales, as they say? Anybody can say, hey, it's our first month, we got 5 sales. Okay, so all your friends bought it. That's great. That's good. But we really want to see replicable and codifying the sales side of it. And so for Stripe, they have all those things. But valuations are going to be tough and going to be down right now. Now is the time to get lean, stay lean, and get to the back half of 2023, because with interest rates and everything else, that's what it's going to be. Now, if you're a business and you're already in motion, now may be the time, if you haven't done it, to think of alternative financing methods. Alternative financing is, if you haven't considered SBA loans because of bureaucracy, you got to work with banks and all this stuff, you might want to consider it. Some of them are 30 years long at reasonable interest rates, makes it a low payment, but don't think of it as 30 years. Think of it as 3, 4, 5 years max, but the 30 years gives you a manageable payment. But don't do it unless you're really at this inflection point where you really think your business is at a point of replication. This is where you can grow your business and drive your business and build muscle while everybody else is inside hiding and waiting for things to come back. Kind of goes back to my comment on social media. This is where you refine what's going on in your business. So don't sit on the sidelines. Now is the time to be working hard and refining who you are, what you are, and really making best use of the people you've got and focus on those people and get those people to be absolutely thrifty and as focused and thinking like an owner as you are. That's how I see it. And so that little note on Stripe just shows you how tough it can be, even for the big boys. So don't fret, don't worry. It's tough for everyone, but now's the time to go build muscle and put yourself in position so when the smoke clears, you are stronger and you have made use of it.